Participants request you to kindly hold. We will start a webinar in a minute or two. We are waiting for some more participants to join. Uh, Evening participants, warm welcome to ASK Investment Managers Quarterly Portfolio Update Call. My name is ABS Ramakrishnamurthy and I am the moderator for today's call. Today, we are updating on ASK Domestic Resurgence Portfolio, how quarter gone by and what are the portfolio changes we made in the last quarter. To update on this, we have Mr. Kuldeep Gangwar, Senior Portfolio Manager who is managing ASK DRP. To introduce you, Kuldeep joined us in ASK 2018. He is having more than 18 years of experience in equities, including over a decade as a sell-side equity research analyst. His core domain expertise is in consumer sector, especially in FMCG and retail. Prior to joining ASK, he was associated with HSBC Securities as a sell-side research analyst. He also worked with Tata Motors for 3 years. Kuldeep did his MBA Finance from IIT Mumbai and BTech from IIT Roorkee, and he is also CFA chartered holder. In this today's presentation, Kuldeep will cover market outlook and what is update on ASK Domestic Resurgence Portfolio. Post this presentation, we will open floor for question and answers. Request all participants to type all your questions in Q&A chat bar. At the end of the presentation, we will curate and get the answers from Kuldeep post his presentation. Without any further delay, I will hand over the floor to Kuldeep. Over to you, Kuldeep.
Hello, everyone. Thanks for joining in. Good afternoon. As Rama has already introduced, it's update about domestic resurgence portfolio, what we have done, how the market is looking like, and the ecosystem we are working in. So if we think about the market, it does make a difference, like how the overall global scenario is. So India as a market has done well, whether we look the CYTD 2024, 1-year return, 3-year, 5-year return. It had been much better than any other market globally. And the reason we believe is that it's supported by strong earning growth, which is happening for last 5 years. And we strongly believe that it should continue for years to come. For us, the crude oil do matter, we are crude oil import country, so it's having implication for current account deficit, to some extent, say fiscal deficit. And thankfully, it had been largely stable, barring few spikes which happen at different interval of time in last 3-4 years. Like whenever there is some geopolitical concern, there is a spike and then it settled down. If we think about, say, domestic situation, so the good news is that India is a bright spot, and IMF has revised its guidance for the GDP growth in India by 50 basis point, and now it expects that it should grow at close to 7%. RBI has brought down, say, inflation guidance by 20 basis point. There is downward revision in the fiscal deficit as well, vis-a-vis, say, interim budget. Current account deficit has come down from, say, 1% in Q3 FY24 to almost 0.6% Q4 FY24. Though election outcome was not in line with expectation, but the continuity is there, and which is quite evident in anything or everything which we have seen in last 3-4 months. If we think about, say, monsoon perspective, El Nino is converting to a La Nina situation, which is a good news because rainfall matters, monsoon matters. There is almost 45% labor force in the agri sector. Almost 2/3 of the population is the rural areas, and the contribution of the agriculture is almost 15%. So as long as the monsoon is good, it's good for the rural economy. It's good for, say, a large part of, say, consumption sector. And whatever had been the shortfall in June, it's being largely covered. If we look about the various indicator, whether the consumption indicator or industry indicators, they are pointing towards, say, resilient economy prospects, like whether it's a two-wheeler growth, which is suggesting more than 20% growth, personal growth happening more than 17% or so. And if we think the same for air cargo, it's again 15% plus, non-food credit growth, again 15%. And it's not about the month story. If we look the trend over a period of time, it's quite consistent. Like personal loan growth had been almost 15 to 18% range for a good length of time. So is the case with the two-wheeler growth. And non-food credit growth had been also very strong for almost 8 to 10 consecutive months, which we have seen, or quarters we have seen. So from the economy perspective, we believe that we are in good shape. And if we think about outlook for, say, domestic economy, we believe, say, inflationary pressure will be relatively lower vis-a-vis what we have seen in past. Global growth had been relatively resilient, though we keep on hearing about, say, so-called stress and expectation that at some point of time, probably the recession may be there. But so far, there was no hard landing, and the things look okay in the global macro scenario. If we think about, say, incoming months, the event which many people will be looking for is the election in US. So this is something everybody will be watching for. The point I highlighted in the beginning that Indian markets are well supported by the strong earning growth, and it should be the case for at least couple of years to come. Like we expect almost 13 to 15% earning growth. The focus areas are infra manufacturing, like recovery of industrial capex has been led by government and the PSU spending. We have seen the green power is witnessing massive investment. Focus on defense and the railway overhaul, power, energy transition, automation and manufacturing, and various initiatives like PLI is boosting the employment opportunity. We are also looking for discretionary spend by the consumer, whether it's say bottom of the pyramid or the top of the pyramid. We believe that higher income should also lead to the higher penetration of many under-penetrated areas. Risk is largely global, like how the crude oil respond if there is any geopolitical situation. If we think the valuation, then Nifty 50 look reasonably valued, like for almost 10-year average, it was close to 20x forward P, and it's close to the same number. So valuation look reasonable at the broader market level. If we come to the domestic resurgence portfolio, so first the recap of the FY24. There was certain, say, exposure which did not do well, like discretionary consumption, chemical sector, financial, and PSU. So chemical sector, as we speak, is still say, looking for turnaround. Consumer discretionary, we think that so good news is around the corner, and the second half of FY25 should be much better than the first half of FY25, or say second half of FY24. So we are quite hopeful that the consumer discretionary should start picking up. If we look at FY23 and FY24, say PSU Bank had done relatively better than the private part of the financial sector. And what did impact our portfolio performance was that we had almost negligible exposure till November 23. So FY24 performance was impacted because of the same. This is something which we have discussed even in the last conversation. And as any problem does require that we recognize the same and respond to the same. So from December 23 itself, we have started making a lot of changes. And in last 9 months, we have increased our exposure towards the PSU, toward manufacturing, infrastructure, capex, and so on, and which have yielded decent return as well. Like if we think about this financial year, from April 25 till July 25, our manufacturing exposure like Polycab, KEI, Titagarh, etc. have done remarkably well. It's almost 30% of the exposure and delivered almost 37% of the return. In commodity, we took the exposure of Gravita about 4 months back, and it yielded almost 70% return in last 4 months itself. And same is the case with the staple. So we have done a great deal of changes in last 9 months. Some of them have started delivering a decent set of outcome, and we hope the rest should also follow the suit. So this is a summary of the changes being done in last 6 months, like IOCL, BHEL, SBI would have come in March. Gravita, Titagarh, Adani Port would have come in April. And in last 3 months, APAR Industries, Ramakrishna Forging, Transformer Rectifier, and Bharat Electronics have come. And we have exited from, say, Dalmia Bharat, HDFC Bank, ICICI Bank, or you can say that we have brought down our overall financial exposure. So these are the new names which are added to the portfolio, like Ramakrishna Forging. Just a brief summary of the company. It's a proxy of, say, domestic MSCV space. Like this company is having almost 77% revenue coming from the auto side. It's the second largest manufacturer and exporter of the forging component, and the railway, mining, and off-highway account for 5% or so. There is a transition going on, like machining mix has improved from 59% to 75%, and whenever it happens, it's a good news for say margin. If we think the diversification per se, we believe that the non-auto business of this company should increase from almost 23% in FY23, FY24 to almost 30% in coming years. So a lot of good diversification in different areas. As well as if we look the company's history, it has done, say, multiple acquisition, and most of them have to deliver good revenue growth, as well as, say, turnaround in those entities should have the margin expansion as well. The company also have a JV with Titagarh Wagon and has won the order worth 12,100 crore plus for from the Indian Railways to manufacture and supply almost 15 lakh forged wheels over 20 years. So company is trying to get into the various areas which should yield good revenue growth as well as say earning growth in years to come. So this is a summary, like we expect in coming years almost 20% plus CAGR for revenue. And from earning growth perspective, it's almost 30% CAGR we do expect from the Ramakrishna Forging. Next is APAR Industry. APAR Industry is quite a diversified company which is having a presence across 140 countries. This company manufactures conductors, cables, specialty oils, and so on. And when everybody is talking about the upgradation in power generation, so it's a proxy play. And same is the case with the, say, it's a positioning in the transformer oil, like in the specialty oil business. If we think about APAR, it's the third largest transformer oil manufacturing in the world. Cable demand should be again a strong growth driver for this company. If we look the segments history, it has grown almost 20% plus CAGR in last 10 years. And today it should be the fastest growing segment. And we believe it should continue for even a decade to come because there are many opportunities, whether it's a renewable, EV, electrification, railways, metro, real estate. So if we think about say company's positioning, it holds almost 70% market share in the wind cable, almost 30% to 35% in the solar cable space. And in the Vande Bharat trains, it's the largest supplier with almost 98% market share. So again, a quite diversified business across multiple segments and should benefit from, say, the energy transition or power generation, say, growth, which will be happening over there. Again, we expect almost 20% plus CAGR in this company and valuation also look quite reasonable. Next is the transformer and rectifier in India. We believe the transformer cycle has just begun and there are 5 to 10 years to go. If we think about transformer rectifier, it's among the top 3 players. It work in the say various segment of the say transformer domain, but it's having expertise in say high class reactors and generator transformers. It had close to 2,600 crore order book as on FY24 end, which actually increased to almost 3,000 crore as on Q1 FY25. We expect that should be a step jump as far as the earning is being concerned. So almost 200% plus earning growth in FY25 and more than 50% in FY26. And even after that, we expect pretty strong earning growth from this company. Bharat Electronics, again, it is more about diversification within the defense space. So we had Bharat Dynamics, we trimmed some exposure over there and part of that exposure was reinvested in the Bharat Electronics. If we think about say DRP positioning over years, like for last 5 years, so if you look at the screenshot, it's quite evident that it was largely a thematic fund till 2019. Consumption and financial used to account for almost 100% of the exposure. Over a period of time, we kept on taking exposure towards the different area of the domestic economy. And we started picking, say, exposure in infrastructure and engineering in 2020. And same was the case for energy and healthcare sector. And over a period of time, we kept on diversifying across various facets of the Indian economy. Today, as we speak, infrastructure and engineering, where we are quite bullish, it's almost 1/3 of the exposure. It's an overweight exposure. Same is the consumption. It's almost 19% of the exposure. So if we look the history, probably the consumption exposure has come down vis-a-vis past, but is still a decent overweight vis-a-vis benchmark over there. So it's an evolution of this particular, say, strategy, from largely limited to 2 sectors. Now it is having presence across various domains of the Indian economy. As we speak, say, psychography of this particular strategy. So we have relatively higher exposure towards say, infrastructure, engineering, and manufacturing. We have reasonably overweight exposure towards say consumption. In the consumption, we cover say both the non-alcoholic beverages, alcoholic beverages, staple, retail, footwear, and so on. In commodity side, we have added Gravita about 3-4 months back. And we have diversified in ports, oil and gas, auto ancillary, and so on, and last 9 months. So this is a snapshot as we speak. In terms of the market cap, almost 50% of the, say, market cap is in the large cap. Balance 50% is in the small cap and mid cap. So decent presence across various segments, and it's basically a bottom-up approach, but we have tried to have a decent exposure towards the various market cap segments. If we look the Q1 FY25 sectoral performance, so if we think about banks, credit cost increase from lows, deposit growth continued to remain a challenge, which led to some margin pressure. there was some higher credit growth across most of the BFSI company, which led to relatively lower PET growth vis-a-vis say PPOP growth over there. If we think about domestic consumption, it has stabilized for staples. Consumer durables have recorded a strong quarter, aided by the heat waves. Other consumer durable categories are also showing some improvement. Domestic investment, which had been the anchor story for last 2-3 years, has continued with strong numbers. Order inflow in the election year was supposed to be a bit muted, so that's the reason the Q1 FY25 had some mixed quarter. Cement had a tough quarter with some sharp impact on the margin. If we look for exporters, IT earnings and top line have stabilized. Hiring trends have been mixed. Slight improvement versus the reduction recorded in the 5 quarters. And that's the reason some improvement in the stock performance of the IT sector as well. Pharma companies have posted the decent set of the numbers. If we look the commodities, the subdued profitability, GRMs have weakened, and that reflected in the relatively weaker performance for the OMCs vis-a-vis last year. Otherwise, in absolute term, it still remains quite healthy. Overall, if we think about say revenue and profit for the BSE 500 ex OMCs, it grew in 8 to 10% range, quite similar to what we have seen in FY24. But there is a difference. Like right now, the profit growth is converging with the top line growth, vis-a-vis FY24, where the profit growth was significantly higher than revenue growth. Performance divergence, which we have seen in FY24 and FY23, where the small cap, mid cap were doing much better than the large cap, that is actually reducing. So across market cap segments, the performance had been decent. We expect that the divergence should further reduce. If we look the summary of domestic resurgence portfolio's overall performance, so in Q1 FY25, there was 12% revenue growth, 20% plus operating profit growth. It's ex OMCs. Vis-a-vis Nifty, which delivered almost mid-single digit operating profit growth. And it had been the story in past that our portfolio company delivered pretty strong earning growth. We believe it should continue for years to come as well. Like in FY25 and FY26, we expect more than 25% earning growth. So return on capital employed, ROE, earning growth, it's quite superior to benchmark. It had been the case in past, and it should be the continuity in future as well. This is something which I have just mentioned that outperformance vis-a-vis say Nifty had been in past, and not only for a quarter year, even if you look last 5-year CAGR, the portfolio companies would have delivered more than 20% earning growth vis-a-vis say 16% earning growth for Nifty 50. Valuation perspective, as we have discussed even in past, that valuation look relatively reasonable, like trailing valuation of the portfolio is quite close to the trough being experienced in last 4-5 years. So if you look history, whether it's a COVID-1, COVID-2, Russia, Ukraine, whatever the bottom valuation we have seen, we are quite close to the same. So theoretically, the earning growth should help in years to come as far as the stock performance is being concerned. This is a snapshot of the domestic portfolio, domestic resurgence portfolio. So from 1 year perspective, there had been drag, which is largely to do with FY24, where particularly the Jan to March quarter of this year had negative implication for the overall performance. And when a particular quarter is bad, year is bad, it also having some implication for CAGR as well. We have tried to recover some of the lost ground, and FYTD, if you look, say FY25, there was some marginal outperformance vis-a-vis say benchmark over there. These are the stocks which have contributed to the overall portfolio return, like Gravitar, Titagarh, Bharat Dynamics, Polycab, REC. They had quite sharp run-up or say strong performance In last 3 months, Grepta almost doubled, Data got almost 50%, and same is the case with Bharat Dynamics and Polycab over there. Even REC had delivered more than 40% return from April 24 till July 24. From a year perspective, Varun Beverages, KI, Bharat Dynamics, Bharti, and Polycab have done well. There was certain drag like AU Small Finance Bank, Naveen. So we have exited AU Small Finance Bank. We have trimmed down our position in Naveen. So we have taken the corrective action wherever it was required. So I will stop over here and happy to take any question which you might be having.
Thank you, Kuldeep, for your brief presentation on domestic resurgence portfolio and what are the portfolio changes with the rationale you explained very well. Now, I would request all the participants to type your questions in Q&A box, and I will ask the questions to the Kuldeep, and I will get the answers from him. Kuldeep, before participants typing their questions, we also collected some questions from our distributor partners and clients. Again, one of the question also come in the Q&A box is that the DRP performance vis-a-vis the benchmark BSE 500 TRI in the 1, 2, 3 years, 4 years range, we have seen severe underperformance. The gap is very, very widened. So what should investor do at this point in time? And because we have done a lot of changes in the portfolio also, which you have mentioned. So when it will get reflected into the overall portfolio returns, that is what the question comes from the audience.
Sure. So if you look the left side of say bottom table, so till 2021 things were okay, like almost 21% CAGR vis-a-vis 19% CAGR. CY22 was a challenging year when the PSU etc. was doing quite well, and most of the growth companies did suffer when the interest rate were rising. So a large part of the underperformance come in 2022. And for this particular year, I mentioned that January to March was a difficult quarter. But most of the things are coming back. And that's the reason if you look, say, FY25, we have almost a 1% outperformance over there. And the same is the case with, say, over a longer period of time. If you look 4-year CAGR, it's almost 25% plus. Slightly short of vis-a-vis BSE 500. If you look 5-year, it's almost 20% plus. As I mentioned, when 1 year underperformance is there, it not only impact that particular year, it's also having implication for compounding rate, because say 8-10% underperformance in a particular year. If we think about CAGR, in 2 years, it will translate almost 4-5%. So it does happen that whenever there is some challenge in short term, it also look optically that long-term performance has also come down. That's the reason we have provided different cut, like the problems had been in pockets, especially in CY22 and then Q1 CY24 this year. And we have tried to do many changes in last 9 months and try to make changes in a direction where we believe that the duration of the earning growth will be relatively superior. So whether it's a manufacturing, infra, capex, defense, we believe it's not for a quarter or a year. This theme is true for many years to come, even you can say for a decade to come. So those are the changes in a right direction, and we believe it has started yielding some result, and we have tried to cover some lost ground in past, and probably in years to come, the necessary changes or large part of the changes are being done. And we have increased our own agility quotient, like say picking the things which is must have and incorporating those changes. So we have done a great deal of it. And as and when it will be required, that we will be doing the future changes as well.
Thanks, Kuldeep. In our portfolio, there are some stocks which are dragging the overall portfolio return, names like, APL Apollo Tubes and Bajaj Finance, etc. So what's your view or what's your take on those stocks? You're continuing to hold those stocks, or how do you see going forward those stocks going to perform?
So if you think about APL Apollo, so like Q1 earning was relatively weak because say operating profit per ton has come down, and probably Q2 will be also on the same line. From Q3 onwards, we believe that both volume growth and EBITDA growth should be quite strong. So if we think from couple of year perspective, we expect say almost 20 to 30% CAGR is doable, though there had been some near-term challenge, whether it's a Q1 FY24 and probably Q2 maybe on the same line. And that's something which we have seen that stock had been pressure. But the point I highlighted, like second half FY25 and beyond, the company should deliver pretty strong volume growth as well as earning growth. And as and when it happened, we have seen this company has bounced back quite strongly, and we believe the future should be also the same. Like as and when the operating performance pick up, say stock performance should also respond. In case of Bajaj Finance, that if we look the operating performance on ground, this company has delivered strong operating performance both quarter after quarter, year after year. And in between, say, derating has happened, and derating has happened for overall BFSI space. From pre-COVID till date, if one sector which has gone through a significant derating, it is the BFSI. So while we have the, say, Bajaj Finance, they might be the other company in the private bank domain, which also suffered the same fate. But as we have said in past that for future and stock performance, the first and the paramount requirement is the earning growth. So this company is delivering day in, quarter in, say year in, year out on that particular parameter. And at some point of time, this valuation derating has to stop, and then this earning growth has to translate into the stock return. At the same time, from the, say, risk control perspective, I will like to highlight that earlier we used to have the exposure toward both Bajaj Finance and Bajaj Finserv. So we have exited from Bajaj Finserv, and right now we are having only the exposure toward the Bajaj Finance. So we have done the risk control part as well, while we remain confident that the earning growth of this company should translate into the stock return in time to come.
So, also, Kuldeep, in the recent times, you also added a lot of PSU names. In that, one of the name is Indian Oil Corporation. You also discussed about BDL, Bharat Dynamics, and BEL also. Now people are now still feel that already the valuations are in an elevated level at this point in time. Now we are entered into the portfolio. What's your thought and what's your views on this all these names IOCL in terms of valuation, and how do you go about it?
So IOCL we entered almost 4-5 months back, not now, and it has done okay from that level. As far as Bharat Dynamics is being concerned, we entered in December, and that stock has almost doubled since that level. In fact, in June, we have trimmed the position by 50%. So the weight of the Bharat Dynamics increased to 6% plus, and we have brought it down to 3%. So we have tried to capitalize on that particular journey, while we are confident that this particular theme is having legs and probably will continue for years to come. So at the same time, we have taken some profit from the table as far as the Bharat Dynamics is being concerned, and used to deploy the same in other spaces.
Also, before going to other question, Kuldeep, can you please unshare your presentation so that people can see you properly? Is that fine for you?
Come again?
Now, can you please unshare your screen so that people will see you very closely?
But it's already open, right?
No, unshare your PPT.
Okay, just a second.
So close the PPT, I'm saying. Yeah, thank you. Thank you so much. So Kuldeep, you are, has given you the introduction of the domain expertise in FMCG and retail as a consumption side, more into predominantly. The question on FMCG as a sector, which is India's fourth largest sector, how do you see the sector is going by? Because if I talk on the Nifty FMCG index, in terms of valuation, PE is 49.5 times, which is higher than 5-year average of industry index. How do you see the sector going forward? And the predominant question is coming from the partners and customers is that We are holding the Patanjali stock in our DRP portfolio, not only in a DRP, it's across all our core portfolios. People still think on that, management and, why Patanjali in your portfolio. Can you please have some light on those particular Patanjali stock also as well?
Yeah. So just to give a brief background, like we entered in the Patanjali in March 2022 or something, or April 22, through say FPO. And at that time, the FPO price was 650. Today is close to 1900 bucks. It's among the best performing stock as far as the say the stock exposure is being concerned. And we believe that every stock should be, or every company should be seen on its own merit and what we think about it. So we should think from the perspective what this company is doing, how this company is evolving. So till 2022, it was largely a commodity company working in the edible oil domain because this company came to Patanjali Group from an NCLT process, and it was largely commodity company till date. After that, one after another transaction happened from say parent to this particular company. So in 2022 itself, they would have transferred say biscuit business and so on. It was almost 1,000 crore worth of business being transferred at 60 crore. In 2023 or 2022, Fagent, they have transferred say food business of say again the parent group. The revenue used to be close to 4,170 crore and they transferred it only for 690 crore. Okay. And if you compare the similar sort of revenue and the profitability, the value of that transfer should have been 25 to 30,000 crore. So parent company has transferred a large part of the value from say unlisted part to the listed part. And it did not stop over there. If you would have seen in recent time, again, the parent has transferred or going to transfer the HPC business to this group. So that particular say part is almost 2,700 crore of the revenue, and it make very decent margin. And if look the quantum, again, they have transferred 1,100 crore. So what is happening? Like if you look the intent of the promoters, they have transferred a large part of the value from the unlisted to the listed, and it only have helped the minority shareholders. If you look what this company is doing, like so they are doing say backward integration, they are doing the palm oil plantation, how it helps, like the company is having almost 2/3 of the import is coming in the edible oil side. So if they do the backward integration, they do this palm oil plantation, it helps the import part. It helps the farmers because once the palm oil plantation is being fructified, it delivers strong cash flow for 20 years to come. So it's good for, say, the third party like farmers being involved. It's good for the country being involved. If you look the profitability part, I highlighted this company is transforming from commodity to brand, from say volatile business to more predictable business, and more to in an area of high growth, high margin business. And large part of the value is being transferred at very nominal prices. So it just shows that the intent of the promoter. So we believe we have to pay attention to these signs because those are the areas which create a lot of value when the perception mismatch is there, which and first and the paramount requirement is that fundamentals should be solid, earnings should follow, and then only these say intangible play out. So this is something we have seen in last couple of years. And if I have to summarize, I will like to believe best is yet to come. Like when the HPC business will get integrated, it will be a lot more stable business, and say non-edible oil proportion will be relatively higher. And when it comes to profitability, almost 80% plus should be coming from this non-edible oil business. So a lot more predictable, higher growth area. So a large part of value creation in terms of the earning growth delivery has yet to happen. So this is something I have to say about Patanjali.
About FMCG as a sector?
So FMCG sector, if you look last year, they had been challenged for the rural growth because the monsoon was weak, and that's the reason I highlighted this thing in the very beginning of the presentation that this particular year the monsoon look appears to be normal, which is a good news for say rural economy, rural growth, and most of the FMCG companies should benefit from say volume growth coming in that particular segment. So earning growth should be relatively better than last year, and which is also reflecting to some extent in the prices as well. From June 2024, when say election results were below expectation, like market had a certain level of expectation from the incumbent government, it did not materialize. So taking into consideration regarding the uncertainty, volatility, etc., there had been some shift which happened in favor of this particular sector, and it coincided with the relatively better prospect vis-a-vis last year. So if I think about FY25, we think double-digit earning growth is plausible in this particular sector. So this is about a staple, and we have the exposure in the FMCG through whether it's a Patanjali or through Varun Beverages, etc. But underlying theme for us remain the strong earning growth. So if the sector is growing 10%, our portfolio companies can grow at 20-30% even in that particular segment, which is not, that particular segment is not known to deliver say super normal earning growth. So this is our positioning. Is if we think about retail, so retail had very tough last 4 quarters, like from almost Q2 FY24 till date. There had been weakness all across, whether it's a footwear or say apparel, whatever you can think of. Apart from jewelry, everywhere there was a weakness. The same weakness appeared in jewelry as well in Q1 FY25. But if I think about, say, a picture going forward, I will like to believe that the things will start coming back from second half FY25 onwards, and discretionary part of the consumption should be much better than with staple. So if say staple is delivering X, probably the discretionary should deliver 2X growth as far as the overall retail is being concerned. So we have the position in the say discretionary part through whether it's a Radico Khaitan or say Titan or Vedant Fashion and Metro Band. So we have seen Metro Band and Vedant Fashion also had the similar situation, like last 3-4 quarters were not good. But I strongly believe that changes are around the corner, and second half should be very good for most of these retailers. And the price performance of some of the retailers are already reflecting that. Like Metro brand has almost moved 30-35% in last 4-5 months, though performance has yet to come. And same is the case with Vedant Fashion, almost 25% movement in last 4-5 months, though performance is yet to come. So those are good franchisee, okay, and near-term pressure had been there from the operating side and largely macro-led. They are niche leader in their respective spaces. So the moment the operating performance start coming in, we are quite hopeful that stock performance should also follow.
Thank you. You answered my another question also in terms of retail, the premium consumption segment, which is Titan and all. Having said that, profit margins are, slightly going down for Titan as a company. If you compare with the industry median, how do you see going forward? Can you please elaborate more on the Titan?
So if you look Titan in Q1 FY24, the revenue growth was close to 9% in the jewelry sector. Vis-a-vis, if you look the say previous quarter, etc., it used to be almost 20%. So there was a markdown, but we should look in the context that it was a strong heat wave, and which had implication on the footfall. It was a quarter which was also having some implication for elections. So not a normal quarter, if I have to say so. And post custom duty cut, there is increased footfall and revival in the volume growth. So again, I will like to believe that these companies should have performance rebound on the operating side, and Titan should not be an exception on that particular part.
Thanks for your elaborate answer. Again, I would request all the participants to type your questions if anything is there, and I will get answer from Kuldeep. Kuldeep, again, another question coming from our partners is that uh, now the government focus is more on there are more capex or spending is going on, infra related and manufacturing and railways, which you have explained very well in your presentation. So one of the stock you have added recent time, which is in a railway segment, railway side, Titagar railway system in the portfolio. What's your view and on the Titagar railways?
So if you look the say history of the railway sector, like go 10-year back or 15-year back, it used to be quite episodic. Like there used to be a railway budget every year, and these stopped to move in tandem. And so say revenue growth or earning growth visibility was missing in this particular sector. If you look the trend in last couple of years, now the government has given multi-year orders. Like rather than say announcing tenders for a particular year, they are giving the visibility to the industry for many years to come. It helps in the capacity planning. It helps in many ways possible. And if you look at the transformation of this particular company, it used to be largely freight wagon, which this particular company used to sell. It's a primarily utility sort of business. Like every year you are producing certain number of freight wagon and having some margin over there. So relatively known territory, known trajectory, and so on. If you think about say changes which are happening, so around the year you will be coming across that the government has announced say metros in this city or that city. We are listening about say Vande Bharat, etc. So what's happening that the passenger say train segment, it is also going through the transformation. So this is the kicker. Like it is still evolving, and so far, if say Titagadi story had been high number of say freight wagon, probably in years to come it will be a story about say passenger vertical, like whether it's a metros, whether it's a Vande Bharat, and so on. And it will start picking up from that perspective. Like it will be another revenue growth driver where the margin improvement will be happening. So visibility coming from different segments. This company is also doing the backward integration, so trying to capture a decent part of the margin as well. Moreover, if you recall, I mentioned about Ramkrishna Forging that they have done the JV with the Titagarh to produce the wheels for the railways. It's another segment. So the point I'm trying to highlight that the promoters are looking for new avenues of the growth. So more forthcoming and uh, thinking more methodically, more strategically, like how we can create the value over a longer period of time. So it's not again a story of a year or two. We believe that railway will be the story of decades. And probably we had to have some exposure in the Titagarh. That's the reason we made entry about 4 months back or so. And the stock has done reasonably well since then. Like we entered close to 900, 2000 level, and it had been reasonably well in last 4 months.
Thanks, Kuldeep. So while coming to the telecom, we have Bharti Airtel in our portfolio. So if you see Department of Telecommunications recently come across and asked that Airtel and Vodafone to replace their 4G and 5G equipment and software technologies from which was sourced from China Chinese companies like Huawei and ZTE. So is there any impact on Bharti Airtel? Because if they want to change the technology, they have to increase the more capex to that. So how do you see that? Any impact on the Bharti Airtel with this change?
No, we don't believe so. Like large part of the infrastructure is already being put in place, and they do say take this telecom gears from say Nokia, Ericsson, or something like that, like European players. And so we don't believe that those are going to be the say factor which is going to have any implication on this particular sector. And more so, the way we think about telecom, we are a lot more positive, a lot more bullish because say I would say the competitive dynamics have now more settled, and which is also reflected in, say, tariff hike, which is happening in regular interval, like almost 2-year interval, but the quantum of the hike is quite reasonable, like almost 20% or so. So we are quite hopeful that the predictability quotient has come back to this particular sector, and which should deliver decent double-digit revenue growth and EBITDA growth and much higher earning growth, because this particular sector is having a lot of financial leverage. So peak capex is already behind that. They were investing on 5G, and they are still investing, but the peak capex has already happened in about 24. So from here onward, the capex should come down, which is good news for the free cash flow perspective, which is good news for, say, depreciation growth happening relatively lower than the revenue growth, and interest should also come down. This company is bringing down, say, debt quarter after quarter. So earning growth can be 20-30% CAGR vis-a-vis, say, EBITDA growth of 15%. So I would say better part of the operating performance has yet to come for these companies and this particular sector.
Okay, thank you. So, one participant asked the question on that, DRP and India Vision portfolio, both are look almost same. We are having call on India Vision portfolio next week, but are we doing any merger in both the strategies? Answer is no for that, right? Yeah.
So the only point I would say, like earlier, DRP used to have a constraint, like we could not invest in the export-led theme. Um, if you look the journey of DRP, like it was launched in 2018, and objective was to focus primarily on the domestic areas. But in last 5-6 years, we have seen that, say, the market is quite dynamic, and we have seen this particular part in 2020 when all of a sudden COVID happened, and April 20 till September 20, it was a very difficult period for DRP, because it's only the export-led theme was working in those times. So whether it was IT, pharma, chemical, and so on. So we brought in this flexibility about a couple of years back, that almost 25% of the exposure can be towards the export. And that's the reason we have done those changes as and when required on merit. So some sort of convergence has happened between India Vision and DRP because of the same. Like earlier, DRP had this particular limitation that it could not, say, invest in the export-led theme, which we can do now. And what happened, like as a portfolio manager, you will like to invest the best of the opportunity in any given sector, unless it's being restricted by the construct. So today, as we have some flexibility available, so we are going for the best opportunity available in the respective sector, and that's the reason some sort of convergence has already happened.
Thanks for that answer, Kuldeep. We have a couple of questions for the day to day. So you have added Gravita India also in our portfolio. Okay. What is your view, and what is the opportunity you're looking in this particular segment, which is where Gravita into the business? How the going forward you are looking the Gravita as in terms of size of opportunity, how are you looking?
So if you think about Gravita, what they represent, like they represent the sustainability theme. Like if you think globally, everybody is talking about the sustainable living, sustainable growth, sustainable economy, and so on. So Gravita is the leader in that particular domain as far as India is being concerned. Like earlier, they used to be limited to lead. Now they are trying to have many new revenue stream, whether it's plastic, whether aluminium, probably at some point of time lithium. And if you are taking a note of, say, the direction the government is taking, like EPR norm in, say, tire sector and so on, we think the opportunities will be far bigger and higher for years to come. And given this particular company had a head start and, say, vision as well, so they are constantly adding new revenue stream, not only in India, but also globally. So they have a large part of operation which is happening in Africa, from where they source, and then they sell in say European side and so on. So we will like to believe that this company can deliver 20-25% revenue CAGR for at least 5 years, and the earning CAGR may be 30% plus. Okay, and so it's not about a story of a year or two. It's a story for many years to come, because there is, say, policy tailwind is available. Like government want this way the economy should evolve, and those things should help anybody who's having, say, head start or presence in that particular domain. So, and earlier this particular sector used to be largely unorganized, so it's offering a combo of say underlying sector growth because of the regulatory changes and the say government desire and support in that particular direction, as well as shift from the unorganized to organized. So we have discussed about Gravita even, I think, in last call. Say we are quite optimistic that the earning growth can be 30% plus for 5 years, and this is something which is evident in the, say, stock performance as well. Like we entered Gravita in that 900 to 1000 range, and the stock has done quite well in last 4 months.
Oh, sure. Thanks, Kuldeep. Yeah. So final question for the day, Kuldeep. So it is on the chemical industry. We have Navin Fluorine in our portfolio, and this name is also, if you see in the portfolio return perspective, it is dragging the overall portfolio return. Now, how do you see, and what is your take on Navin Fluorine going forward?
So, as I mentioned in the beginning, that in about 24, the chemical sector overall was a drag, and turnaround in the prospect of this a particular sector had been delayed. So we have brought down Navin Fluorine exposure materially. I would say almost to negligible extent as we speak. So this is what I have to say about Navin Fluorine, that we have brought down our exposure materially as we speak.
Sure. Thanks, Kuldeep, for your time. We have not further questions. Yeah, there are some questions coming into the picture. So Trent Limited, one of the participants is asked about the Trent Limited is the best part of DRP. So can you please elaborate Trent Limited? I'm not able to understand. The participant was typed on Trent Limited.
I don't know.
Yeah, that's what.
Like what he's looking for in that.
No, Trent Limited, we don't have any exposure on this particular name.
No, we don't have the exposure.
Yes. Okay, cool. Thanks, Kuldeep. We are coming with end of the session today. Request you to kindly give your closing comments, if any. Otherwise, we will close the call.
Thanks everyone for joining in. As we spoke during the course of the presentation, that in last 9 months we have done multiple changes in different areas, and particularly in the areas where we believe the earning growth will be a lot more sustainable, a lot higher. So we have done a great deal of changes, and some reflection of the same is already evident in the performance. And we believe as and when it would be necessary, we will do, say, other changes as well. But today we believe that the portfolio is having a decent composition and exposure towards the area where, say, growth opportunity is likely to be quite superior. That's all from my side. Have a good day, and we will meet next time.
Thank you so much, Kuldeep, for your time. Thank you so much, all participants who are joining this today's call. We will end up the presentation now. Thank you so much once again.
Thank you.